One question I get asked quite frequently by directors of small to medium-sized businesses is what options do I have to use surplus cash that's within their business to fund their retirement? Well, the first consideration for most people is to extract money from their business by making pension contributions. That's the most tax-efficient option. But I have clients for whom making pension contributions is not an option because they've already reached their annual or lifetime allowance. If this is you and you have surplus capital within your company and are concerned about low interest rates and higher inflation, investing within your company could make sense. One option is to use an equity-based collective investment, as this allows any gains to be deferred until the investment is surrendered and the dividends to be effectively paid tax-free to your company as what's known as franked income. Over the long term, history shows that equity investing has given a great opportunity to achieve returns greater than inflation, which is of course crucial at the moment, a time of soaring inflation rates. There's opportunity to make an equity-based collective investment even more attractive by structuring the investment in a tax-efficient manner. What's more, as the investment remains owned by your company, the funds can be used for future business purposes if and when you need to. The potential advantages of corporate investing are pretty clear. So now let's address how the money can actually be extracted from the business in a tax-efficient manner later on. One option is to retain the investment within the business, keep that equity-based investment in the business after the company stopped trading, and then treat the company as an investment company. The shareholders can then draw the dividends during retirement from your now investment company until they are exhausted. This is especially attractive if your company could not be sold for some reason. Maybe you own a consultancy company where the value is intrinsically linked to you. The tax rules state that an investment company will normally not qualify for capital gains tax business asset disposal relief or inheritance tax business relief. However, because you will be drawing the funds as income, this means that it will never be a capital event and therefore the loss of business asset disposal relief is irrelevant. What's more, where the capital is drawn and spent during your lifetime, business relief becomes less relevant. Another option as the owner of the business is for you, and of course potentially your spouse or civil partner, to use the dividend income from the investment company, your investment company, once you've finished trading to fund your retirement. Each of you could use your £12,570 personal allowance and your £2,000 dividend allowance, with the remaining income taxed at basic rate of 8.775% on a dividend as a basic rate taxpayer. Bear in mind that the personal allowance is frozen until 2028, but the dividend allowance is going to reduce to £1,000 in April 2023 and then again to another £500 in April 2024. And of course, be aware that when a company declares a dividend, the proceeds must be split equitably according to the number of shares each shareholder owns at the time. So, if for example you and your spouse are 50% shareholders, each holding the same type of shares, you would each need to receive the same level of dividends. Also, be mindful that a dividend is a payment a company can make to shareholders if it has made a profit. And that means a company must not pay out more in dividends than its available profits from the current and, of course, previous financial years. So, is taking an income via dividends worthwhile? Well, let's assume you and your spouse or civil partner took an income up to the basic rate tax threshold, which is frozen at £50,270, until 2028. You could extract £100,540 each year with a tax rate of just over 6%. That's lower even than the 10% business asset disposal relief rate, which may have been available if you had followed an alternative route. Taking an additional income from your business in this way allows you maybe to leave your tax-efficient pension funds invested for longer before drawing down the funds, which of course in turn increases the value of the inheritance tax-efficient assets that you hold. Another upside is that retaining the company structure provides the opportunity to gift shares to maybe the next generation as part of an intergenerational estate and legacy plan. I hope that's helpful. My name's Justin King. I'm a chartered and certified financial planner, and my aim is to help you have a successful life that often involves understanding your money. I have a podcast called the Retirement Cafe Podcast. You might like to tune into that. I'll put a link in the description below. And I have a weekly newsletter which is packed full of retirement tips that you can also subscribe to. I hope it's useful. If it has been, please press the like button and of course subscribe so you never miss a video. Thanks very much for watching. Bye-bye.